Imagine a company that grows its core product by 71% in a single year.
Right.
The company that recently had its first ever operating profit, completely crushed its domestic rivals, and is somehow successfully selling luxury products at a massive premium.
Right.
And this is all happening in the middle of a brutal macroeconomic environment.
Yeah, it's pretty wild to see.
But then imagine that same company's stock being just completely decimated by Wall Street. I mean, trading at a fraction of its former highs, totally paralyzed. That is the paradox we are looking at today with the Chinese EV maker, NIO.
It is arguably one of the most fascinating standoffs in the equity markets right now.
Yeah.
You have this explosive, undeniable fundamental growth on the operational side, and then a stuck chart that looks like a slow-motion train wreck on the other.
Exactly.
The market is basically staring at the financials and simply refusing to believe the narrative.
Well, welcome to Market Pulse Daily. Today, we are aiming our lens squarely at NIO using some AI-aided stock research from StockOracle.
And for you listening, our mission today is to decode this massive market paradox. Is NIO a misunderstood, coiled spring just waiting for the broader market to wake up and reprice it? Or is it a classic value trap skating on incredibly thin ice that is about to crack?
Right. And real quick, before we jump into the fundamental catalysts, just a reminder that you can check out StockOracle through the special 14-day trial link below in the description. It's an AI-aided research platform for things like fundamentals, valuation estimates, moat analysis, and portfolio research.
But do keep in mind, StockOracle isn't financial advice or a buy or sell recommendation or real-time market data. AI insights can be incomplete or wrong, so always verify important facts yourself. Also, that link is an affiliate link, so the channel may earn a commission at no extra cost to you.
Okay, so let's unpack this business from the stock, because the Chinese electric vehicle market is just an absolute bloodbath right now.
Oh, it's a daily knife fight for market share. But if you look at the business of NIO purely through their operational output in July 2026, they delivered over 35,000 vehicles.
Which is huge.
Yeah, that 71% year-over-year growth you mentioned isn't just a spreadsheet anomaly. They brought their first 7-month deliveries for 2026 to over 227,000 units.
But wait, I mean, automotive manufacturing it's not like a software business, right? You can't just press a button and scale output by 70% without, massive operational friction.
Right, the physical scale is brutal.
So I'm looking at these mid-2026 numbers, and I really want to know how the actual cash engine is handling that kind of physical scale.
That is the exact right question, and it is where the story gets really interesting. Because initially, the financials seem to validate the growth perfectly.
How so?
Well, when you push that much physical volume through your factories, you achieve something called economies of scale.
Right, spreading out the fixed costs.
Exactly. Your fixed costs, the factory lighting, the heavy machinery, the baseline salaries, they all stay the same, but they are distributed across far more vehicles. Because of that, Q4 2025 revenue hit a massive 34.7 billion RMB. That's up 76% year over year.
That is incredible.
And more importantly, gross margins nearly tripled to 19% in Q1 2026 compared to the prior year.
19% gross margin in a hyper-competitive EV market is no joke. Like, that's huge.
It's vital. And it culminated in a massive milestone. In Q4 2025, they recorded an adjusted net profit of 728 million RMB. To put the scale of that turnaround into perspective for you listening, in the exact same quarter the year prior, NIO lost 6.5 billion RMB.
A multi-billion RMB swing.
Exactly. It is a violent swing toward profitability.
Okay, I see the milestone, but, if you look at the stock right now, it's trading at $4.82. It's down nearly 40% from its 52-week high of $8.02. Set back in October 2025.
Right. Wall Street clearly doesn't buy the turnaround narrative.
Yeah, and frankly, looking at the trailing 12-month metrics, the TTM numbers, I don't entirely buy it either. How can a company boasting a 19% recent gross margin still sit on a trailing net margin of negative 9.09%?
It looks contradictory, for sure.
I mean, their earnings per share over the last 12 months is still negative 396 cents.
Well, you are identifying the exact friction point that has Wall Street paralyzed right now. You are looking at the trailing metrics, which are basically the historical hangover of scaling.
A hangover, okay.
Yeah, think of trailing metrics as looking strictly in the rearview mirror. When an automaker scales up, when they build the factories, design the chassis, construct the supply chains, they burn billions of dollars years before the first car rolls off the line.
So it's basically the ghost of past investments dragging the numbers down.
Exactly. What you are seeing in that negative 9% trailing margin is the company finally digesting the massive historical cost of building the machine.
Okay, so the trailing numbers show what it costs to build the factory, but the forward numbers show what the factory is finally yielding now that it's running at capacity.
That's a great way to put it.
But, the analysts projecting NIO's future are using some heavily adjusted math. I'm looking at Goldman Sachs' projection from the StockOracle data here, and they are forecasting a massive swing from a 12.4 billion RMB loss in 2025 all the way to a non-GAAP net profit of 1.6 billion RMB in 2026.
Right, that's a huge jump.
But non-GAAP just means they are stripping out certain costs to make the picture look prettier, right? Why should we actually trust that adjusted number?
It's a fair skepticism. Non-GAAP metrics strip out things like stock-based compensation and one-time restructuring costs. Analysts use it because it gives a clearer picture of the actual cash-generating power of the core business.
So it removes the accounting technicalities that muddy the water.
Exactly. And the reason Goldman expects that massive positive swing isn't just because NIO is selling more cars, it's because management is aggressively cutting the fat. In Q1 2026, NIO slashed R&D expenses by over 40%.
Wow, 40%.
Yeah, and they're selling general and administrative expenses by more than 20%.
So they're dramatically lowering the cost to operate the business right at the exact moment their vehicle deliveries are exploding. That creates a massive inflection point.
It really does.
But let's talk about those deliveries, because if NIO is growing at 71% in July, they have to be taking that market share from someone else. How are they winning in a market where everyone from Tesla to BYD is actively slashing prices just to keep their factory lights on?
Well, if we look at the July 2026 data, while NIO was jumping 71%, their rival XPeng only saw a 4% year-over-year growth in deliveries. Li Auto actually saw their deliveries decline.
Ouch.
Yeah. And the mechanism behind NIO's win is entirely counterintuitive. In a brutal price war, they are explicitly not discounting their cars.
Wait, they aren't?
No, they're aggressively protecting their premium luxury positioning.
Which defies basic economics. If the broader Chinese economy is facing headwinds and competitors are offering discounts, why on earth is the average transaction price for the main NIO brand sitting at an astonishing 443,000 yuan in June?
And it held strong at over 434,000 yuan in July, too.
Right. For you listening, that is roughly equivalent to a $60,000 luxury vehicle. Why are consumers paying that premium right now?
It really comes down to product appeal and structural lock-in. From a pure product standpoint, their large SUVs, specifically the ES9 and the ES8, are massive hits.
Yeah, the data says the ES9 alone secured over 25,000 non-cancelable orders by June.
Exactly. It has been such an overwhelming success that Deutsche Bank actually had to revise their 2026 delivery forecast just for that specific model up to 56,000 units.
But, every major automaker eventually designs a good-looking SUV. A cool chassis and nice leather seats don't create a lasting competitive advantage. There has to be a mechanical reason why consumers choose to pay luxury prices for a NIO over a discounted Tesla.
There is, and it is the absolute core of NIO's business model. It's their battery swap network.
Right.
If you buy a traditional EV, you are entirely dependent on finding a fast charger, plugging in, and waiting 45 minutes to an hour for your battery to replenish.
Which is a huge pain.
In densely populated Chinese cities where very few people have private garages to charge overnight, that time commitment is a massive friction point.
So instead of charging, you pull a NIO into a swap station. A machine physically drops out the depleted battery, bolts in a fully charged one, and you drive away in 3 minutes.
Literally 3 minutes. It operates identically to a traditional gas station.
That is wild.
And this creates a powerful ecosystem moat. If you're a Chinese consumer and you get used to the luxury of swapping a battery in 3 minutes, the psychological barrier to going back to a traditional plug-in EV is massive. You are locked into their ecosystem.
I see the appeal, for sure. But building thousands of robotic battery swap stations across a country as large as China requires a staggering amount of capital expenditure.
Oh, absolutely.
If they are slashing their operational costs like we discussed earlier, how are they funding this massive infrastructure rollout without bankrupting themselves?
Well, through a transition to what the StockOracle research calls asset-light partnerships. Yeah. Historically, NIO funded and built these stations entirely on their own, which burned through their cash reserves aggressively. Now, they're franchising the model, Think of it like a fast food franchise.
Okay, so NIO owns the proprietary technology, the software, and the recipe.
Exactly. But they're partnering with outside investors and state-backed entities who actually buy the real estate and fund the physical construction of the swap stations.
Okay, that makes sense. It scales the structural moat without directly draining NIO's balance sheet. But this brings us right back to the bear case.
Right.
If they have 71% growth, highly coveted luxury pricing power, and this expanding franchise battery swap moat, why is Wall Street treating this stock like it's radioactive? Why is it trapped under $5?
Because beneath the impressive delivery numbers and the high-tech swap stations, the financial foundation holding the entire company up is razor thin. Wall Street isn't looking at the cars, they're looking at the balance sheet.
It's not looking good.
No. Right now, NIO's shareholders' equity sits at just $626 million.
For a global automaker competing against titans with tens of billions in cash, $626 million is nothing. It's a rounding error.
It is terrifyingly thin. This fragility is perfectly encapsulated in their price-to-book ratio, which is currently sitting at 16.98.
Let's break that metric down for a second because it's crucial for understanding the downside risks here.
Definitely.
A price-to-book ratio of roughly 17 essentially means that for every $17 an investor pays for a share of NIO on the open market, the company only holds about $1 of actual, tangible, sellable assets like cash, factories, or inventory.
Precisely. The vast majority of the stock's price is based purely on the expectation of future growth, not on hard assets. There are zero shock absorbers here.
So if things go wrong, it goes really wrong.
Exactly. If Goldman Sachs' projection of a 12 billion RMB positive cash flow in 2026 actually materializes, NIO is fine. But if management makes one single strategic misstep, or if the price wars force them to finally lower the prices of those luxury SUVs, that cash flow vanishes.
And if the cash flow vanishes, they hit a liquidity crunch. They would be forced to go to the open market and raise capital just to survive.
Which is the last thing shareholders want.
Right, because the only way to do that is by issuing millions of new shares, which severely dilutes the value of the shares currently held by everyday investors. That dilution risk is a massive dark cloud hanging over the stock.
It really is.
But if you look closely at the research, there is an even bigger red flag signaling danger. And it's coming from inside the house.
You're talking about the insider trading data.
Yes. Over the past 90 days leading up to this data, the corporate insiders at NIO, the executives and directors who know the daily operations better than anyone, they have sold a net 350,000 shares.
That's a significant number.
The data notes only 3 insider buy transactions compared to 6 sell transactions. If the Q4 2025 operating profit was the definitive turning point, and this asset-light franchise model is working flawlessly, why are the insiders quietly heading for the exits?
Well, insiders sell for many personal reasons, of course. But when you zoom out and look at the macro environment, you start to understand their caution.
What kind of macro environment?
Analysts at Morningstar are explicitly warning investors not to extrapolate a single quarter of profit into a long-term trend. They point to brutal headwinds, specifically looming European tariffs that directly threaten NIO's European expansion plans.
How do those tariffs fundamentally alter NIO's business model? Because tariffs aren't just a tax, right? They force a company into a terrible lose-lose decision.
Exactly. Let's say Europe imposes a massive tariff on imported Chinese EVs, specifically targeting NIO's upcoming, more affordable Firefly sub-brand.
Okay.
NIO has 2 choices. They can absorb the cost of the tariff themselves, which instantly destroys that beautiful 18% vehicle margin we talked about,
Right.
or they pass the cost of the tariff on to the European consumer by raising the price of the car. But if they raise the price, the Firefly is no longer affordable and it can't compete with domestic European brands.
So either way, demand or profitability gets destroyed.
Bingo. And that macro reality creates a massive gap in expectations between what NIO's management thinks they can do and what the analysts think is actually possible.
Right, because management has established an incredibly aggressive volume growth target of 40 to 50% moving forward.
But Morningstar is modeling a much more conservative 29% growth estimate.
That's a big discrepancy.
It is. Morningstar also highlights a critical internal risk, which is cannibalization.
Oh, like their own brands eating each other?
Exactly. NIO launched the Onvo sub-brand to capture a slightly lower price tier. But there is a real risk that instead of attracting new buyers who otherwise would have bought a Tesla, Onvo just steals buyers who were originally going to buy a more expensive NIO.
Ah, and if that happens, total revenue drops even if volume increases.
Exactly.
So you have this intense tug of war, bullish analysts at Goldman Sachs projecting a golden era of free cash flow, and cautious analysts at Morningstar, alongside the company's own insiders, hedging their bets against tariffs and a fragile balance sheet.
It's a classic battle of sentiment.
So how is the broader market sentiment acting as the referee in this scenario? Because from the technical analysis and the research, it seems like the market has just walked off the field entirely.
The technical picture is the definition of paralysis right now. The stock is hovering near that $4.82 mark, and the trading volume is completely subdued.
How low is subdued?
It is currently running at just 0.73 times its 3-month average.
Wow. For you listening, low trading volume means the big institutional money, the mutual funds and hedge funds that actually move the market, they aren't taking a side.
They aren't eagerly buying the dip, but they aren't panic selling either. It's a wait-and-see standoff.
So it's just stuck.
Yeah, the stock is trapped in a 13-week downtrend of almost negative 20%. There are no technical signals showing a breakout to the upside and no signals showing a total breakdown.
So what breaks the stalemate? I mean, if I'm looking at their upcoming Q2 2026 earnings report in late August or early September, I don't even care about how many cars they delivered anymore. The July numbers already told us that.
Right, the deliveries are baked in.
What I want to see is the cash burn. I want to know if they proved that Q4 2025 profit wasn't just a fluke.
That is the ultimate test. Deutsche Bank is expecting non-GAAP break-even for Q2. If NIO can prove that their vehicle margins can stay stubbornly above 18% despite the raw material costs and the domestic price wars, the narrative shifts.
They need to validate that inflection into positive free cash flow. If they can show actual cash piling up on the balance sheet, it instantly neutralizes that terrifying price-to-book ratio.
Exactly. It proves they won't need to dilute shareholders to survive.
And from a purely technical standpoint, the market will signal its belief when the price action reclaims the $5.50 mark, right?
Right. Reclaiming that level would establish a higher high on the daily chart. It would break the 13-week downtrend and signal that institutional money is finally stepping back in.
And we also have to acknowledge the wild card here, which is the Chinese government. The research mentions speculative hopes around accelerating EV policy support.
Yeah, that's a huge potential catalyst.
If Beijing rolls out aggressive, formalized subsidies or purchase incentives specifically targeting smart connected EVs, that is a macroeconomic tailwind that could violently lift NIO's stock, regardless of their individual margin execution.
True. But banking on unpredictable government subsidies is speculation, not investing. The core focus has to remain on their operational leverage.
Absolutely. It really is a masterclass in market dynamics. If you were listening to this and analyzing your own portfolio, NIO is the ultimate case study in why headline numbers are never enough.
Headline numbers can definitely be deceiving.
A 71% growth rate is phenomenal, but if it is built on a foundation with zero shock absorbers, the risk profile is astronomically high. They have the premium product, and they have an incredible franchise moat with the battery swaps.
But their execution going forward has to be flawless. One misstep, 1/4 of margin compression from a European tariff, and that thin ice shatters.
It really does force you to look beyond the immediate quarter and ask a much larger question about the company's ultimate destiny.
Definitely. I mean, we talked about how brutal the auto manufacturing business is, fighting for single-digit margins while burning billions in capital.
Right.
But what if NIO's long-term play isn't actually about selling cars?
Wait, what do you mean?
Think about the asset-light battery swap network. They have successfully built a proprietary, highly efficient infrastructure system that solves the single biggest pain point of EV ownership in high-density cities.
Yeah, charging time.
Right now, it's a moat to sell their own luxury SUVs. But if the global auto market truly becomes an unprofitable bloodbath of tariffs and price wars, what stops NIO from pivoting?
Oh, wow.
They could theoretically open up their swap network, licensing the technology to other major automakers who failed to build their own charging infrastructure.
That completely flips the script. Instead of fighting a brutal battle to sell a consumer discretionary product, they transition into an energy infrastructure monopoly.
Exactly. They become the underlying grid that powers their competitors' vehicles.
They transition from a low-margin hardware manufacturer to a high-margin licensing and utility company. It's a radical shift, but in a market this cutthroat, it might be the most valuable asset they actually own.
Exactly.
Now that is a paradigm shift to keep an eye on. Is the real value in the metal they are selling or the robotic infrastructure they've built underneath it? Something to mull over the next time you look at the EV landscape.
Very true.
All right, thanks for joining us on this edition of Market Pulse Daily. And remember to check out that 14-day trial for StockOracle in the description. Just keep those risks in mind. We'll see you next time.